All right, let's connect straight up with the Managing Director and CEO of Bank of Baroda, Mr. P.S. Jayakumar, who is joining us to talk about the big bank merger. Thank you so much for taking time out. Good morning and welcome to ET Now. So clearly it's three banks that are going to consider that proposal of the merger, and this is going to create India's third largest bank. Can you just take us through what exactly is the timeline in terms of this, sir, according to the information that has been given so far?
Well, the timeline is determined by a legal process that involves, in step one, the boards of the respective bank approving the merger, followed with a mechanism to determine the swap ratio, which is in accounting cum law cum investment banker cum SEBI regulation related rules to be decided. Then there is a requirement that the scheme of amalgamation is drawn up, and that, once approved by the government and the RBI, would require it to be placed before both the houses of the parliament for 30 days, and thereafter the remaining formalities would get completed. So my estimate is, and I could be wrong by 1 month both sides, is somewhere between 4 to 6 months' time.
Right. Mr. Jayakumar, this is Poonam here joining in from the Mumbai studio. So first up, just wanted to understand, we're seeing quite a bit of criticism as well. If you look at the Bank of Baroda stock, it is down in trade, and one of the key criticism is that synergy benefits would in fact be slightly difficult to be extracted from a PSU, from this kind of a PSU bank merger, because Dena Bank is definitely a weak franchisee, although we do have Vijaya Bank as a relatively stronger franchisee. What would you have to say to your shareholders?
Well, let me put it to you this way. If I were to look at Bank of Baroda on a standalone basis, the amount of results we have hitherto achieved on number of products per customer itself requires substantial augmentation. Towards this end, we have set up some centers of analytics and technology and a bunch of other changes that would enable us to realize those benefits. So in the first instance, Bank of Baroda on and by itself has not reached the levels it needs to reach from a cross-sell and more products per customer perspective. So we have to keep that in consideration as well. So as we move down that path and as we get the results on, we're going to see substantial improvement in the numbers of Bank of Baroda. Now, by virtue of the fact that we already have an established processes or what is called as use cases to get results, and I assume Vijaya Bank and Dena Bank have also got some successes of similar type, it will be possible for us to transport these experiences across. So the essence of any of these mergers is a quick ability to transfer successes and then be able to leverage on them. But clearly I see there is a lot of opportunity because we have all scratched the surface with respect to our own portfolios. The second thing is the synergy that is discussed with respect to branch rationalization and cost structures. That's a second part of it. But I just don't subscribe to this synergy issue primarily because I'm saying within ourselves we have still not realized the kind of opportunities we have. We have put ourselves in a path to make that happen, and we have created effectively infrastructure to be able to big data lake and so on and so forth. Therefore, we are well positioned today to be able to get synergies and then transfer successes which exist between organizations so that we can get the best practices around. So I'm not that pessimistic about the outcome. I would rather say I'm very optimistic, and it's a very highly likely scenario.
Well, I'm glad that you're quite optimistic about the overall outcome that we may see. But you have to start
with the question whether a bank itself has achieved. No, leave aside merger. We have not achieved the kind of results we need to do, but we have put in place a strong process and it's reflected by our growth momentum. Now, these use cases we have built are extremely transportable to other organizations, assuming they don't have it. But if there is something better they have, then obviously there's an opportunity to build that further.
Right. So first up, has there been, your term ends around the first week of October itself. Has there been communication from the government in order for a term extension? And more so, how keen would you also be probably to head the merged entity? Would that be a possible outcome that we should be seeing now?
Well, as you know, these are decisions for the shareholders to make, the government to make, the board to make. But I can only speak for myself, which is that having given regard to all the factors, I had communicated to the government and to the others as well, stakeholders as well, that to the extent they feel that my continuation is necessary, it is available. I have been fairly unambiguous on this position.
Right. Speaking about the stressed assets there, if I look at your net NPAs, the combined entity would be having a net NPA of close to around 5.7%. And of course, we all know that Dena Bank would be one bank which would be dragging the overall return on assets because they do have a negative net worth there. What is the kind of stressed assets that the merged entity would be seeing? What is the pressure that you see in terms of the overall provisions, in terms of the profitability for the merged entity?
I can only speak with information that is available in the public domain, because that's what I have with respect to both Vijaya Bank and with respect to Dena Bank. But I was just looking at one number, which is the total net NPA plus restructured assets. On a standalone basis, Bank of Baroda in March of this year was 23,483 crores. The combined entity was 36,000 crores. So I still think that's how the ratios are playing out, right? It's not doubling. And it's kind of seems to me somewhat proportionate to the respective balance sheet. Now, one of the things that is always a question is that whether every bank has got similar type of loss recognition, similar types of loss provisioning, and is it possible that somewhere it is less than the standards that are set by Bank of Baroda for itself? The answer to that is this, that over a period of time, the Reserve Bank of India and the government and the boards of the respective bank have moved forward for a better disclosure and recognition of non-performing assets coupled with the provision coverage ratio. If you were to take that factor into mind, it's very likely that all the issues are known and are on the table, and the provision coverage ratios are also available. So one would expect there should not be too much of any kind of a negative surprise. That's really what I would say. On the other hand, it's an evolving market. Things don't remain the same. Companies that are performing suddenly don't perform. Things that are looking bad suddenly gets corrected. So it is a very dynamic scenario. But on the balance, I think situations must improve from the point where we are here today.
Right. Mr. Jayakumar, if I look at your return on assets, you have a positive ROA of nearly around 0.29%, and the combined entity would be having a negative ROA. Assuming that, of course, you would be heading, and this is an assumption again, that you do get to head the merged entity, how soon do you think that we could see a positive ROA for the merged entity? How soon do you think that we would be able to see an overall turnaround in terms of the business? Because one thing is for sure, that the turnaround that you had probably planned for a standalone Bank of Baroda, that is now going to take a back seat, and now your focus would again probably be in terms of the merger and integration issues, etc. So how soon could we expect the merged entity to come back to profitability?
So we're talking about the merged entity probably presenting its first financial results in the first quarter of 2019, or maybe the last quarter of 2018, somewhere there, right? Now, I generally think that overall there are two aspects about it. One is the immediate profitability of the return on asset, and second is structurally how we are moving forward with growth ratios, coverage aspects, etc., etc. And also about products and about customer growth and everything else. So I think by and large I expect that each of the individual entities would hold their own position, that the integration effort would be run in a dedicated fashion by a steering group or representatives, so any other mechanisms that we do. And I do expect that the momentum, the existing momentum, and Vijaya Bank has also been showing very strong growth momentum, should not get disturbed, that there is a part that does business as usual, and there is a much smaller part that works on the consolidation initiatives.
Structural challenges that we're seeing for a lot of the mid-sized banks right now. I'm just talking about an overall perspective, and this has also been the third major restructuring that we've seen in the public sector banking space. I just want to understand your views as to how you're looking at this. Is there going to be more consolidation on the cards? Is this really the way to go now?
Well, the prevailing wisdom and the various committee reports, including that, if I remember, of Mr. Tarapur, have always been articulating the need for a consolidation, a fewer number of larger players, and a reasonable number of smaller institutions that are geographically or segment focused. That broadly is where I think the prevailing viewpoint seems to be. Now, as regard to whether there is going to be any other additional mergers, frankly, I wouldn't know. And I think that's a question asked to the wrong person.
Right. Mr. Jayakumar, in terms of the capital, do you think that now the merged entity would be seeing a capital adequacy ratio of nearly around 12%, a CET1 ratio of slightly over 9%? How much of the capital would you be requiring, would the merged entity be requiring from government? What would be your take on it?
I think I'll try to put it to you in two parts. The first is the fundamental position of the government articulated by in the various discussions and press interviews, etc., as well as yesterday's presentation, that capital is available for, incremental capital is available for the merged entity as a position. Now, what should that number be? There is a mechanism to do it, which is that we put together a combined plan, look at a certain number of years, maybe 3 years, and then we try to make a business case for more capital. And once that is made, and that's kind of accepted, then I would assume the capital will flow through. But like everything else, any request for capital must be put to some degree of rigor of analysis, and that's only fair, and it has to be done objectively. That's where it is. So first, let's get past the process relating to getting the approvals. Then let us get together a consolidated position. Then let's get the business plan in place, and then move forward. But if I were to look at the next 12 months number or the next next 3 quarters, for example, as you point out, with a combined CET1 ratio of 9.33, which is what it is today, as of 30th of June, I think there is sufficient headroom for us to grow without necessarily waiting for an immediate influx of capital.
All right, Mr. Jayakumar, appreciate you taking the time out. You've given us a lot of clarity on the big merger, what it means for the bank, the kind of operational efficiencies that we will see on the back of this, as well as a lot of details on financials and how you're viewing the step as a whole in terms of consolidation in the banking space. Thank you for taking time out and joining in.